Hello and welcome. Good afternoon. This is the Q4 2025 Market and Economic Update. My name is Paolo LaPietra. I am a certified financial planner and director of portfolio strategy, also a wealth advisor here at the Bouchey Financial Group. I'm going to be the host for today's webinar, but I do have my colleague Edward Wilhelm, senior portfolio trader and investment analyst, also with me today. And this webinar is really going to be focused on the story of momentum. And part of that is going to be the discussion around a Q4 market recap, talking about the economic resilience and normalization that we've seen in the economy, and also highlighting the valuations, earnings in 2026 market outlook. And where I always really like to start is just doing a last quarter market recap. And with last quarter being Q4, I thought it would be more prudent to just do a full year for 2025. So that's what we're looking at here. We could see the tech-heavy NASDAQ was the leader of indices last year, up 21.14%. Then we had the S&P 500 up 17.88%. The Dow Jones Industrial Average up 14.92%. And last but not least, for the equity side of the equation, we also had the Russell 2000, which is small caps up 12.81%. Then we could see that orange line right there. That is the Barclays aggregate bond index that was up 7.3%. So very, very positive year for bonds and obviously also equities as well. As far as our tactical allocation within the portfolios, we'll see on the right-hand side, our overweights are still the US stocks, also the growth sector, mostly technology, followed by nuclear, semiconductors, and cryptocurrency in the form of Bitcoin. Where we continue to be underweight is international equities, sector specifics, small caps, and short duration bonds. Now, something that I did want to highlight is what we could see on the left-hand side. This graph is looking at the new tactical positions that we added to our portfolio back at the, kind of near end of Q4. And it was actually the end of November. And what we saw during that time was a little volatility, specifically in the technology side of the equation. And we saw this as a nice entry point to enter three tactical positions that we laid out here. The first one is NLR, that is our nuclear position for energy, and we'll certainly get into this a little bit more, both myself and Ed. But we'll see that nuclear, since we added it in November, is up 29.37%. Semis, which are chips in the form of SMH is the ticker, are up 23.05%. And then also Bitcoin in the form of HODL, up 5.86% since we added. All three positions, very nicely outperforming the S&P 500, which I also highlighted here, which was up 4.89%. So these tactical positions have been great, and you'll really get an inside look on exactly what our thesis was and our rationale behind adding these positions with some of the economic data that Ed will share and also some of the valuations, earnings, and stock, review that I'll go into at the end of today's webinar. So without further ado, I'm going to pass it over to Ed, who is going to give us an economic overview.
Awesome. Thanks, Paolo. I know we usually like to start with labor, but this quarter I wanted to start with inflation and get it out of the way. This chart shows the year-over-year inflation rate measured monthly. The blue bars are the inflation prints, and the dashed red line is the Fed's 2% target. Now, the big picture is pretty clear. Since late 2022 and early 2023, inflation has meaningfully cooled, even though it's been a bit sticky over the last year. Inflation is still above the Fed's 2% target, and they've been pretty clear that they're comfortable operating around these levels. Now, long-term averages tend to run closer to a bit above 2, between 3%, and that's what we're seeing, and that's not unusual from a broader historical context. Now, where that stickiness in inflation is coming from does matter. Most of it is housing and core services rather than goods. Goods inflation has largely worked itself out. The last part of this process is really a services and shelter story. Now moving on to labor. This remains the key area we're watching, and it's also central to how the Fed is thinking about their policy. Over the recent months, we've seen the Fed continue emphasizing labor and wages, a result of the sticky services inflation, which is tied more closely to what people earn. This chart shows the monthly payrolls, or how many jobs are being added or lost each month. The blue bars are job gains, and the red bars are job losses. The black line is a 3-month average, which helps smooth out some of the noise. What we've been seeing is a clear softening trend. Job growth has slowed meaningfully from these strong levels we saw earlier in the cycle. You'll notice some of the volatility towards the end of 2025, especially that large negative print in October. Now, that wasn't a clean signal of the labor market breaking down, but really just a result of the government shutdown and some messy data. When you step back and look at the trend, this is really a gradual cooling, not a market that's breaking. And that's exactly what the Fed has been looking for. As inflation moderates, a cooler labor market helps reduce wage pressure without requiring a spike in labor or unemployment. Let's look at a few other labor market trends we're watching. The chart on the left shows total job openings over time. Job openings have come down from the post-pandemic highs and are now closer to levels that look consistent with a healthy pre-COVID labor market. That's an important distinction. This is normalization, not deterioration. The labor market is finding a better balance with fewer excess openings per worker. On the right, this chart shows the monthly number of layoffs. Even with hiring cooling, layoffs have remained relatively low by historical standards. We haven't seen the kind of broad-based job cuts that typically show up heading into a recession. The key theme across both charts is stabilization. Job openings are normalizing, layoffs are staying contained, and the labor market is gradually returning to a more typical pre-pandemic trend. One important nuance in the labor market is the slowdown showing up most clearly at the entry level. This chart compares the unemployment rate for recent college graduates aged 22 to 27 with the broader workforce. You can see that joblessness has risen more noticeably for younger graduates than for workers overall. That lines up with what we typically see when hiring cools. Employers tend to pull back on new hiring first, even while overall layoffs remain muted. This becomes more challenging when you combine it with still elevated housing costs. Higher rents mean younger workers have less flexibility since a larger share of their income goes towards essentials. So, while the overall labor picture remains healthy, this slide helps explain why the experience can feel very different depending on where you are in your career. Next, I want to spend a minute on productivity because it's an important piece that ties a lot of this together. This chart shows US productivity, a measure on how much the output of the economy is producing per hour worked, where each bar represents a quarter. What stands out is the trend. Productivity was fairly stagnant coming out of COVID, but over the last couple of years, we've seen a meaningful pickup. The economy is getting more output from roughly the same labor base. It's no surprise an uptick in productivity coincides with the widespread adoption of ChatGPT. Since early 2023, the growth rate here has 5x'd. That matters because higher productivity allows the US to grow without the labor market overheating. It means companies can expand without needing to hire as aggressively or push wages higher. This helps explain why inflation has been able to cool while employment remains steady. Stronger productivity can offset wage pressures. The bigger takeaway is that productivity is an underappreciated tailwind and it supports growth, helps contain inflation, and gives the Fed more room to ease over time without reigniting inflation. Now let's look at the interest rates and how markets are thinking about the Fed. This chart shows the federal funds rate path. The blue line is the actual path we've seen, about 175 basis points or 1.75% of cuts since early 2024. And the red dashed line is the market's current expectation based on federal funds futures. The table on the right breaks that out by each meeting date and shows what probabilities the markets are assigning to different rate outcomes. The key takeaway is that markets are pricing in a very measured path forward, roughly 2 25 basis point cuts in 2026, and this is not a recession-style cutting cycle. It's important to remember that this is just the market's forecast, not a promise from the Fed. Policymakers have been very clear that they're staying data dependent. We also have a Fed decision and press conference today at 2 p.m. with expectations for a pause, not a major shift in policy. And the backdrop here matters. It ties directly to the slides we just walked through. Inflation is moderating, the labor market is cooling but still stable, and productivity is improving. Together, this reduces the need for restrictive policy. Now, what could change this outlook? Two main things would be a reacceleration in inflation, especially areas that have already cooled like goods, or a more abrupt weakening in the labor market, like consecutive sharp drops in hiring or a spike in layoffs. Now, switching over to the consumer, we're going to take a look at how they're holding up. This chart shows the month-to-month percent change in personal income and personal spending. It's tracking whether households are still earning money and whether they're still spending it. The key takeaway here is that we're seeing continued positive growth in both areas. Spending remains supported because incomes are still growing, even as the labor market cools. That cooling we talked about earlier hasn't translated into a pullback from consumers. You can see fairly broad-based increases in both income and spending across the months. There are a few noisier periods, but overall, the trend is still positive. Households are spending just in a more normalized and sustainable way compared to the post-COVID surge. The consumer continues to look healthy, and that's a big reason the overall economic backdrop remains constructive rather than stressed. Now, looking at GDP. This chart breaks down the real economic growth by its major components: consumer spending, business investment, trade, and government, with the black line showing the overall real GDP trend. The most important takeaway is that consumption continues to be the core driver of growth. Those darker blue bars line up with the healthy income and spending data we just walked through. Now, you'll notice a dip in early 2025 that was largely distorted by trade flows, as seen by the red components in each bar. A surge in imports temporarily subtracted from GDP, even though underlying domestic demand remains solid. Once you strip out that trade noise, the broader trend is still positive. Growth has cooled from the post-COVID surge, but the economy is still expanding. This also ties back to productivity. A steady consumer and improving productivity are supporting growth, while most of the volatility we're seeing is coming from trade swings rather than weakness at home. Zooming out, this slide highlights the continued emergence of a K-shaped economy. It means different parts of the population are having different economic experiences. Some groups are moving ahead while others are falling behind. If you picture a capital K, one line is moving up and the other is moving down. This chart breaks down wealth by percentile going back to 2018. The higher up on the chart, the wealthier the group. The clearest takeaway is that the top segments of the wealth distribution have continued to gain, while the bottom half has seen much slower progress. A big reason for this is asset ownership. Higher income households tend to own more stocks and homes, so they benefit directly when asset prices rise. Lower income households are more exposed to higher costs and have less ability to compound wealth over time. This helps explain something we touched on earlier in the slides. While consumer data can look strong in aggregate, even while some groups still feel stretched, especially younger renters in lower wealth households. So while the overall economy remains constructive, the experience is not uniform, and that divergence is an important backdrop for both policy and market behavior moving forward. Now I'll kick it back over to Paolo, covering valuations, earnings, and a market outlook.
Thank you, Ed. So a lot of great information there, and I want to kind of shift our focus a little bit and look a little bit more into markets. And like I said at the beginning of today's webinar, 2026 is shaping up more for a year of momentum than anything else. And with this momentum that I'm discussing, where I want to start is by taking a look at stock valuations. You know, a byproduct of all the success that we've seen in the markets the last few years, frankly, from 2023 till now, seeing double-digit returns in the S&P 500, is higher valuations. And that's exactly what we're seeing on this chart. This chart goes all the way back to 1994, and we're seeing the fluctuations of S&P 500 valuations in the form of price to earnings, you know, and going up and down, going back to 1994. And we'll see if we look all the way to the right, as of December 31st of 2025, we're trading at near those high valuations. You know, we kind of peaked back in 2021, and more formally, we see back near the dot-com bubble, those higher valuations. And the reason why I want to point this out is higher valuations can be challenging for markets. A lot of economists will point that that can be, kind of the telltale sign that, more volatility is on the way when we're trading at these higher multiples. But where I really want to focus us is the earnings justification behind these valuations. So if companies are earning, then these higher valuations can be traded. That's fine. We could continue to move forward. And this is what we're looking at here. A lot of numbers here. Promise I'll walk us through it. But this is actually breaking down the S&P 500 earnings analysis looking back at Q3. And the first couple circles I want us to focus on is the first one is the S&P 500. 85% of the companies beat their earnings for Q3. That's a big, big number. That's showing a very healthy earnings season. And if we keep on looking to the right there, the second red circle that I have is 6.7% surprise on the upside. That's a real positive. But even more importantly, if we continue to bring our eyes down here, we're seeing technology sector, 94% of those companies beat their earnings with over 7% surprise on the upside. So that's a really important data set that shows that corporate America is doing well, and that's a nice support for these higher valuations that we're seeing in the markets. But the one thing that we definitely know is the markets will look at what's going on now and what's happened before, but more importantly, the markets want to look at what's going on ahead. So that's why in this next slide, I really want us to take a look at the earnings outlook going forward. So this is showing EPS growth for the S&P 500 year over year going all the way back to 2001. This is not a historian webinar, so we're really going to focus on the right-hand side. And we'll see in 2024 and 2025, we saw EPS growth of 10 and 11%. And then we'll see for 2026 and 2027, 15% forward guidance earning growth in the S&P 500. Those are the numbers that we need to see in order to sustain those higher valuations that we're seeing. So we're seeing last quarter earnings look strong. We're seeing forward guidance on earnings growth continue to look strong as well. So valuations at this time, not a concern for us. Now, something that Ed just talked about is rate cut expectations. The Fed funds future market is pricing in most likely 2 cuts this year. We are getting a new Fed chair in. Ed also pointed out we have a Fed meeting later this day. We'll get more clarity on that. But one of the other conundrums that we hear most often by either clients or call-ins on the radio, friends, family, whatever the case may be, is should I be investing into markets at all-time highs? It's an age-old question, and it makes sense, right? You never want to buy in at the top. But what I wanted to point out here is just looking from a historical standpoint, how does the S&P 500 perform at all-time highs when rate cuts are on the table? So we're going to see 3 lines here. The first line we want to take a look at is the blue, I want to say blue, maybe light blue, a line here that shows cuts with no recession. So at all-time highs, if the Fed cuts and we don't see recession, on average for the trailing 12 months, we see the S&P 500 return 18.2%. Very strong numbers. Now, focusing in on all cuts, whether it's a recession or no recession, we're seeing that's that kind of black line. On average, the S&P 500 returns 13%. Now, finally, all the way at the bottom, kind of that orange-red line, we're seeing S&P 500 all-time high with cuts. With a recession, we're seeing an average of negative 2.7%. So worst case scenario, we see a recession, which none of the economic data is supporting that. We're seeing on average only a negative 2.7% decline from here. Now, if we don't see a recession, we know we're averaging between 18.2% and 13%. Those are very strong numbers, a nice tailwind to also put behind this market. Now, a story that we talked about last year, continue to talk about this year is the CapEx story, right? Capital expenditures, how much companies are investing in their infrastructure and their build out. And this chart here is looking at all of the major hyperscalers within the United States. So more specifically, we're looking at Amazon, Google, Facebook, Microsoft, and Oracle. And we'll see that the numbers in 2024 toppled 200 million. I'm sorry, 200 billion with a B. Those are big numbers. And then we even jumped higher in 2025. We saw those numbers tower 400 billion. And we see these numbers even grow further in 2026 and 2027, with forecasts in 2027 touching almost $600 billion. These are major numbers. And this is a nice tailwind for the economy, because this type of capital expenditure just creates more GDP. It creates more of a build out, jobs, infrastructure within the United States, and something that we continue to focus on and ways to massage within the portfolio. But, a lot of times when we talk about all the capital expenditures we're seeing, we'll say, hey, Paulo, this seems eerily familiar to the dot-com bubble. I'm like, okay, I really wanted to find something that highlights the fundamental differences that we saw during the dot-com bubble and what we see now. And I think this chart does exactly that. So I'm going to explain it a little bit, and then I'm going to walk us through it. There's two lines, obviously, that we're seeing here. The first one is the blue line, and that is representing CapEx to sales. So how much is a company investing in their business, and how much is that correlating to actual sales? So we want to see a high number on this, right? We want to see a high return of capital that companies are investing and also seeing the back end with sales. So the higher the blue line, the better. Now the yellow line here is showing you the share of capital expenditures that is financed through debt. So how much a company is investing within their own company, but they're actually financing that through debt and not free cash flow. So a higher yellow line is going to be bad, right? Because a company, yes, is growing, they're investing in their business, but they're only doing that through debt. They're not able to suffice that through their own cash flow or their own sales. So now let's analyze this chart. So we'll see during the dot-com bubble, both the blue line and the yellow line are high. So yes, in the dot-com bubble, companies were selling, but they were also investing in their companies without having the cash flow to sustain that. It just wasn't sustainable over time. And that's why we see that massive sell-off after the dot-com bubble. Now let's fast forward all the way to the right where we are now. This is the healthy sign that we're looking for, right? We're seeing CapEx to sales increase. So we're seeing a return on capital, what you want to see as an investor. But more importantly, we're seeing the share of capital expenditures financed through debt at all-time lows or near all-time lows. So companies are generating more sales and seeing more return on capital, but doing it through free cash flow, not through debt, which is a very, very healthy sign for where we are right now. Now, another thing I just wanted to quickly talk about is the energy demand. Through this whole AI trade, there's been a huge energy demand that's happened across the country and globally, specifically off the backs of data center and AI. So this chart here looks at two lines. The first is going to be the green line that shows the supply base, so how much energy is currently available within the United States. And then the orange line is looking at the demand, right? So how much energy is being demanded from data centers, AI, infrastructure, you name it. And what we'll see, back in 2024, starting to see some, divergence. And this is only expanding as we go on through 2025 to all the way forecasted out to 2030. There is a huge energy crisis and a continuation of an energy crisis within the United States. And that was central to our thesis of why we added nuclear energy into our portfolio. There is a lot of money that is backing it. There's legislation that is supporting it. We wanted to make sure that we got in early within this energy trade. And there's always going to be continued opportunities within the space. But you could see that trade has already paid off, since we've added it to the portfolio, dramatically outperforming the S&P 500. Now, another market catalyst I really just want to wrap up here with is the market breadth. And this is something that's been really important. Because when, the last few years when we looked at markets, it's really been a massive concentration around technology. And that's just not sustainable. If we just have one sector within the economy that continues to be the market catalyst year in and year out, that is not going to be a healthy market to continue to go on. And what we'll see is in Q3, the earnings growth, we're starting to see a lot of sectors, also participating in this market upside. So, of course, we continue to see information technology continue to do well, but also financials, utilities, materials, and industrials all seeing more earnings growth compared to the overall S&P 500. So this overall participation by more sectors is really just another healthy sign to show that this market continues to have some gas left in the tank to continue that momentum that we've seen for the last few years. Now, where I really want to wrap up on, because I just covered a lot of bullish points and a lot of tailwinds that will continue the momentum within the markets for this year, I really want to hammer in one thing. Volatility is to be expected. We looked at this chart before, but it's always good to come back on this. And as a reminder to how to really digest this chart, those gray bars are showing the S&P 500 return in any given year going all the way back to 1980. And the red lines are showing the intra-year volatility that we see. So even if we look all the way to the right in the more recent year, the double-digit returns we've seen for the last 3 years, we still see a lot of intra-year volatility. That is natural. That's what comes with the market. That's what we're preparing for within the portfolio. Steve says it often, volatility is our friend. I feel that volatility never lasts, but long-term investors do. And again, that's central to our thesis. And the reason why I want to point this out is we talk about all the bullish signals that we see for 2026. We fully expect some volatility pockets along the way, but that's why we have diversified portfolios to support that. So folks, that is all we had for today's webinar. I really appreciate everybody joining. As always, if you have questions, comments, concerns on anything that we covered, always feel free to reach out to the office, talk to your advisor. We're here to answer any questions that you may have. Please stay warm out there. I did look at the weather forecast for the next week or so, and it continues to be cold, which is never fun. But again, want to thank everybody for spending a little bit of your afternoon with myself and Ed, and hope you have a great rest of your day.